Today, we're going to look under the hood of some index funds and market dynamics to start the year. And there's been some volatility to start the year here, but the overall market as defined by the S&P 500 in this video, year to date has been basically flat. So we're going to look at a couple charts. The first chart here is brought to us by Bespoke Investment Group. As you can see on the chart here, as of February 17th, the S&P 500 was basically flat for the year so far. As Bespoke points out, there are 94 stocks out of the 500 that make up the index. There are 94 stocks that are up or down less than 5% per year. So, 94 out of the 500 aren't really doing much on the surface here to start 2026. But on the flip side of that, there are 117 stocks that are up or down more than 20% this year. So a lot of stocks are moving around a lot. Speaking to, the volatility that I mentioned at the top, two things I want to mention here about these stats. The S&P 500 is a cap weighted index, which means the biggest stocks have a heavier weight in the index than smaller stocks do. Currently, the top 8 names in the S&P 500, the biggest 8 stocks in the S&P 500, make up around 35% of the overall index. So each index fund, it's important to know that each index fund has its own weighting methodology. We're just talking about the S&P 500 here as an example. There's so many indices these days. There's so many index funds, and everyone just kind of likes to throw a blanket over it. But, these different funds kind of do things differently. So it's important to understand that. The second thing I want to mention about these stats here is the averaging out concept and how under the hood things look a lot more volatile than just, the overall fund's performance. This applies to the broader market as a whole. One of our favorite stats here is from Ryan Dietrich. So he went back and looked at the S&P 500's return on an annualized basis, and it returns, he said, between 8 and 10% per year. So he went back to 1950 and looked at how many years on a year-to-date or per year basis actually finished in that 8 to 10% range. He found that only 4 times since 1950, or about 5% of the time, has the S&P 500 actually finished between 8 and 10%. It varies from, some years down 20%. The last couple of years have been up 20%. It averages out to that 8 to 10% per year. But if we, the path to get there looks a lot different. And that's kind of what's happening in the broader market, the S&P 500 overall this year. A lot of stocks are moving around a lot and experiencing volatility, but on the surface, it appears pretty calm. One more chart for us to look at here. This one is from Bloomberg. So this chart shows that 330 stocks in the S&P 500 are actually outperforming the overall index itself on a year-to-date basis. Again, this is because the highest weighted stocks aren't the ones that are outperforming. Because those stocks are weighted so heavily in the S&P 500, the overall index isn't really feeling that too much. So what can we take away from this? It's that diversification has paid off this year. Diversification away from the biggest stocks in the market has paid off recently. It doesn't mean it will continue to do so. It doesn't mean you should, rip up your portfolio or change anything. But it just goes to show that owning different areas of the market are going to lead the charge in some years, and then they're going to, lag it in other years. And, the laggards from the years past are going to be the ones that lead us now. And it's just going to fluctuate, and trying to jump in and jump out and time which areas or sectors of the market are going to outperform and underperform on a yearly basis. We think it's a fool's game here, and you're just going to drive yourself crazy trying to do that consistently over time. So just wanted to take stock of what's been happening in the market to start 2026 here. It allowed us to talk about 2 really important topics. The first being average returns and how we can expect anything but average on a yearly basis. The path to get to average returns isn't always a smooth straight line. The second big topic is diversification. Owning different areas of the market pays off, and trying to, time what's going to be outperforming versus underperforming on a yearly basis is really difficult to do on a consistent basis, and diversification will pay off in the long run. Thanks as always for watching. We'll be back with you with the next one.